Good evening, everyone. Welcome back. A quick bit of information before we start. As you would have noticed, the startup series have moved from Arctic Invent company page to my personal profile on LinkedIn. This is to bring more interactivity to the series, as we soon be mixing events with audio events, and that's not available on the company page, where we'll be inviting our guest speakers and have more interactive sessions where we can pick up your questions. So we are working out the formalities. So stay in touch. Watch out for the space. So let's come to today, right? So you have out your investor with your elevator pitch. The stakes are high, the possibilities endless. The meticulous crafted pitch deck and comprehensive supporting document have passed the initial scrutiny. You have arrived at the moment of reckoning, a transition from courtship to business nitty-gritty. Welcome to the process known as due diligence. The rigorous open the book and shows your card process, most of the startup approach with mixed feelings. Investors are ramping up due diligence in the wake of financial irregularities and malpractices by startups in the recent times and recent news. This is especially true for early stage companies where investors are now insisting for a proper financial due diligence and otherwise to be completed before even material round of financing. Today, we will peel back the layers of due diligence to make sure when you walk into that investor meet, you can convince them your startup is worth their time and most importantly, their money. Welcome back to the Startup Series, a series where we address problems that deep tech startups and founders face in their day-to-day running startups. I'm Govind Kedia. I run Arctic Invent, which help companies increase their enterprise value by way of building business-centric IPR portfolio. My company, Arctic Invent, has worked with more than 1,000 plus startups from Europe, US, and India, helping them build massive value on their product and technologies. So we have a lot to cover today. So let's dive right in and bring our guest speaker, Banik. Banik is managing partner of Arthur D. Little, India and South Asia. He is responsible for ensuring a preeminent position for the firm in the region. He's also responsible for building Arthur D. Little's global competence centers in India and artificial intelligence research and graphics. Banik has over 2 decades of experience in consulting, strategy, and technology. He's technology expert, Silicon Valley investor, board advisor, published author, and a renowned speaker. He's passionate about contributing to national nation building in India and has participated in creation of a Public Health Foundation of India, PHFI. Welcome to the Startup Series, Banik. And if I missed anything, please add and also tell a little bit about Arthur D. Little and what it does. It will be great for our audience to know about it.
Yeah, cool. So let me talk a little bit about why I am here and what ADL does. So I think I'm here on this because, as Govind is aware, I do a lot of diligences on behalf of funds into not only startups but more established companies. I think over the last 20 years, I have been involved in commercial diligences of deals which have probably added up to more than 50, $60 billion, right? So I do diligences for big companies, small companies, startups, often on behalf of funds, right? I think so 90 to 95% of the work I do is for funds. There is also another kind of diligence which is called vendor due diligence, which is done not for the fund, but often the company or the target themselves hire an advisor to create a business plan and an information memoranda. But again, most of my life has been spent on the other side of the table, which is not on the side of the table of the founder, but unfortunately on the side of the table of the investor who's looking very carefully at the firm to invest in. So a little bit about ADL. ADL is a management consulting firm. We provide advisory services across full company strategy lifecycle, ranging from strategy to execution. We are very focused on working in emerging sectors of the economy, and a lot of startups are also present in some of the sectors we have strengthened. Which is why, as we were discussing right before the call, we have been involved in some diligences very recently on leading edge technology companies or deep tech companies in the startup space. So that's what we do. But again, I carry a lot of diligence experience from this firm and also my previous firm where I used to do this for a living. So that's why I'm here. Hopefully, we'll spend some time demystifying the whys and the whats, right? And what startups can get from the process.
Absolutely. Thank you, Barnik. And of course, one thing to add, Barnik is, amazing person to talk to and very down to earth. Thank you, Barnik, again. Now let's talk about due diligence. It's a process most of the startup would approach with some apprehensions, right? I mean, sometimes, of course, called as necessary evil, so to speak. But the process in reality can be startups' best friend and their golden ticket sometimes as well, right? In your work, Barnik, Would you would have worked with many startups in the process, of course, while working with the big ones. What would you tell startups about accepting the process as something beneficial? What do you think should be their approach when they hear the word due diligence, especially from the investors' perspective?
Yeah. See, I think the good news is if the startup has heard the word due diligence, it means they're already in a reasonable space with the firm or fund they're talking to. I think it means, by the way, again, to use the terminology used, Govind, is that the venture capital firm has already decided to spend its time on the startup. Now, the only decision they want to take a call as to whether to write them a check or spend their money on the startup or not. In fact, even initiating a due diligence actually costs the venture capital firm some money because they have to pay some advisors to actually conduct the necessary process. May not be management consultants, sometimes legal advisors, sometimes accounting advisors, and all of that. So, congratulations, you're at a point where your partner or your fund has actually really decided to put some money at play to see whether you are really worthwhile for them to write a check to. So I think that's the one thing to look at it. I think the second thing the startup should realize, and this is what I find very refreshing when I talk to a lot of startup participants, I think due diligence is also a very important learning journey for a startup, particularly in the early stages. Right. In fact, in a lot of cases, firms and investors often encourage their advisors after the process is over, right? And in case there's a positive outcome, to share some of the outcomes of the process, which just makes the startup far more firmer and far more solid in terms of their outlook, right? And the other thing they will also find when they're going through the due diligence process is you will also see a little bit about how the firm you're partnering with thinks about the space and thinks about you in the space. You will see that if you talk to different venture capitalists and you do different DDs with them, you will see they actually don't all ask the same questions. The questions may look the same, but the kind of investigation which happens is different. So again, you get to while a due diligence seems like a forensic investigation of yourself, I think the firm is also showing part of their soul to you as they go through the process. So I think you should welcome it. For me, any fundraising process is nothing but a matchmaking process. So it is both parties have to be willing to come to the table and sign an alliance. And I think the diligence is a good formalized dating process where it's structured, it's templated, and you have a nice third party often in the mix who's also brokering the information. So I think you should treat it very positively. There's nothing negative about it, right? So
Sure. No, I think thanks, Banik. And one related question, and in fact, this question is something very very kind of related to what you just said. And it was a conversation with a startup founder. They just got some commitments from some investors, and his view was that, look, I mean, I'm leaving everything. I'm not building my startup. Since 3 months, I've been doing this, giving data and helping the due diligence. What's your view on that? I mean, just to understand, how much time it takes, because heard some of the startup founders, getting really frustrated when they hear about this topic, and that's why I bring this question. So before I, talk a bit more, but I want to really share the pain that I heard from a startup founder and wanted to hear your view. How they should be tackling this problem and situation as well for them.
so listen, the way to look at it is try to look at it differently, right? I always tell startups that the most precious asset you can part with is your own equity, right? So it means that if you've decided to really dilute equity, you're doing it for the right reasons and you're doing it for the right partners. So that's one way to look at it. It's an important decision. It's not a frivolous decision which will be done in 3 4 days of talking and you'll get away with it, right? So that's one thing. It's a serious decision. Secondly, remember the person who's going to come in or the firm which is going to come in is going to pretty much going to be living with you inside your startup, right, in whatever shape or form for the next 3 to 5, often 7 8 years. So it is quite important not only for them to know you but for you to also know them. And a due diligence is a great process for you to also see how they are thinking about the business, how they are thinking about exit. Is their vision of building the business aligned with yours, right? At the end of the day, funds may have different views of building the business, they may have a different view of exiting, and it's better to know what those views are upfront versus discover it 2 3 years down the line when you run into
Mhm.
some trouble. So for me, it's time well invested. You've taken a decision to dilute equity, which is the most valuable thing, so you should spend more time on it. And this is also another reason why you should not do funding every 12 18 months, right? Because I think that also, I know a lot of startups who, founders who have raised capital and then build their business for 6 9 months and then another spend 6 months raising capital. I think, beyond that phase in which that's going to happen. So when you raise capital, spend enough time on it, raise enough money so that you don't have to do it every year,
Hmm.
and then ensure that the firms or the funds you're partnering with are people you'd like to work with on a day-to-day basis to scale your company, right? So for me, it's not only, it's if you treat it like a two-way investigation, I think you'll probably welcome the effort, because you're also trying to learn a little bit more about the people who are investing in you.
Great. No, thanks, Banik. I think very valuable lesson about how to really approach this, and also very valuable insight that when you are raising fund, raise enough for the that you don't need to go through every frequently. So thank you for sharing that. So with that setting the tone, let's get more into detail of the topic. We just have 1 hour or less now, so I'll try to cover as much as possible. So first, let's can you help me understanding what are the broad areas of due diligence process, especially in startup in the deep tech space, I would want to focus on. It will be good to know what are the external factors of due diligence and what are the internal factors of due diligence as a bucket, and then we'll pick up one bucket and talk about it.
Cool, good. So before I give a detailed answer, let me just tell you that uh, the diligence area is very significantly based on the stage of funding. The areas of investigation for a later stage funded startup, either a Series C or Series D plus startup, looks very different from someone who's writing you a seed check or a Series A check, right? So that is one thing to note. And I have a very simple framework to think about it, right? I think uh, at the beginning, people are looking at potential in the early stage. Then they're looking at promise, right? Which means you have to show some results, and then show a pathway to growth. And then when you get to late stage, it is all about performance, right? So again, remember, if you're talking to an investor for the first check, you're raising $150,000 or $500,000. You're actually trying to prove to the investor about the potential of your idea and why you are the right person or the right team to deliver on the idea. When you're somewhere between Series A to Series B, people are looking at not no longer the potential but the promise, which means have you demonstrated some traction for the potential. And then when you get to Series C, Series D, it's all about numbers. What have you delivered?
Mhm.
What's the path to economics profitability? How profitable are you going to be? Very late stages, people would ask, what's the path to a capital market exit? So the questions become different and the questions become more invasive. That said, across all of these phases, there are some common blocks. It's just the emphasis on these blocks which differ by stage of diligence. I think first thing, very standard, people will look at the market, right? And you will hear a lot of terms like addressable market or TAM, right? What's the revenue potential, right? And I think here, what I have learned is that most spaces are multi-billion-dollar spaces, right? I don't think there's any doubt that any space you pick in India or any other emerging market, you can do any amount of math to get to an opportunity which seems huge. I think investors are quite interested to understand what drives value and what some of the dynamics in the space are, and what the solution you're proposing, how that's going to shape the dynamics. So that often comes to the second area. I believe this is very closely linked to the market size itself. It is an element of the product market fit, which you may call, or what is the problem you're trying to solve, and is your solution going to really be able to make money in a market which seems big? Now, there are various ways to look at it, but I think there is a fundamental investigation on this. People try to look at what other players are doing, what people have done in other markets. You will find in the early stage, a lot of venture capitalists ask this question, which I know no one likes to be asked of, right? That what are you building, right? Are you
Mhm.
building the Facebook of X, or are you building the Google of Y? And the reason they do it, at one level, you can joke it's a little bit of intellectual laziness, because you
Mhm.
will always claim as a founder that, listen, they're not doing their homework. But it's also to see, okay, if I can draw a parallel, because I can understand a movie whose story has played out, right? And
Mhm.
you're trying to do that movie in India, or you're trying to do that movie in that sector. So then do I understand that? So there is a fundamental block of understanding the market, the competitive dynamics, how people make money, what are competitors doing, right? And what are you doing which allows you to make money? So I think there is a little bit of investigation here. And here, by the way, Govind, to your framework, a lot of these parameters are external.
Mhm.
At which point of time investors or their advisors are looking for market reports, they're looking for research, they're looking for sizing. So if you have any such information with you, which you've used your information or sizing on, please feel free to share it with your fund, because they will also be looking for it. So any external validation is better than you claiming. If there's
Mm,
a branded advisor like us or someone else who's claimed it to be $100 billion market, investors find that easy because they can defend it back to the investment committee and say that, listen, XYZ company has actually done an independent research which suggests that this industry is a $50 billion industry in India. So that's point one. The second thing people are very interested in, and this is equally important to the market, is the team. And we'll get to the team later, but
yeah.
here people are understanding the founders, their background, the skill sets. They want to understand how they work well as a team. And trust me, there is reasonable background checks which happen, right?
Mm,
I myself have been asked to give references on my IIT batchmates and my IIM batchmates. I have called juniors of my colleges to find references on founders. So again, I don't want to put anyone on a back foot, but people will find out who you are, what kind of a person you are. They will call your childhood friend, they'll call you a wingmate, they'll call you a dom mate, they'll find a lot of things, right? So there is some kind of understanding of the team, but from a intellectual point of view, I think the simple question the investors want to find out is this the right team to solve or to disrupt the industry, which we are now convinced there is some size to, right? So what are the skill sets the team builds, right? Is there someone who understands technology? Is there someone who's in the market? And obviously, when you're asking a first check, I think people are more making a bet on one or two people. But if it's a Series B, Series C, they're interested in the second level of detail and who's there. So there is reasonable scrutiny on the team. Third, I think there is fundamental scrutiny on the technology or the product which you're trying to build, and people want to understand whether you've understood the consumer. So any kind of consumer research you may have done, any kind of ICPs or profiles you may have built, any kind of market testing you've done is very valuable, because that gives them a sense that the product you're building has some feedback. So, by the way, people love customer testimonials, right? If you've managed to
mm,
create some pilots and all of that, and this becomes far more important as you go down the funding life cycle. Obviously, product market fit needs to get better as you go along. But there's an investigation on product, and fourth is financials, right? People want to look at the business plan. People want to see how feasible the business plan is. Obviously, in the early stage, there's no test of how practical the business plan is. So I think I always advise people that while you are making a 5-year plan, remember the next 12 months is very important, because that's where the investors always look at a business plan. They look at the 5-year number, but they put far more scrutiny on the year one, year two number to see if it's believable or not, right? Because if you're believable, then there's a path to the 5-year number. So these are the three,
sure.
four blocks. Often there is also assessment on the technology itself, the competitiveness of the
Mm,
technology, the distinctiveness of the technology, whether there's an IP. But again, it may be a technology, it may be a business model, but people will dig deeper. And these things become far more important in later checks, when people are writing 50, $100 million checks, where there'll be far more formal assessment of the technology in terms of intellectual property and all of that, which becomes over. So these are the 4 or 5 broad blocks. uh, Typically, what you should know, that if you're in an early stage looking for less than $1 million of capital, a typical due diligence process runs few days, 8 to 10 days, right? Particularly for Series A. So within 8 to 10 days, the investors try to find out as much as they want. So they will prioritize questions. When you're writing a large check, which is 100, $150 million, the diligence can be 6 to 8 weeks as well, right? So
sure.
you can understand the depth of questioning and scrutiny for us
Mm,
in a 6 to 8 week diligence period will be far more intense than an 8 to 10 day period, right? So again, you
sure.
just should be ready, right? Not all
Sure.
diligences look the same, but I would say the larger the check sizes you ask for, the higher the scrutiny is, the more painful the I would say the root canal looks like, right? So if it's a
Sure.
small check, it'll feel like the nice tooth extraction with an ice cream at the end. If it's a $150 million check, it'll feel like a root canal with many sittings, right? We have to go again and again
Sure.
and do it.
No, thanks, Varnik. And I think very, very important learning. I think a very nice framework of potential promise and performance. Very nice way to put it. And also, how this really works out. And very interesting question. I have to take this question because it's kind of quite related to the discussion that you just had. So, question from Bo is: have you seen these criteria changing given the current funding situations? Are these changing by space or region? I also know one of the startup founders that I just asked about, who was sharing a painful story. He said that his due diligence was going for like a for 3 months, and the check size was not huge. I mean, something around less than a million or something like that. So, some take on this, and then we'll quickly jump the next of the question. We have a lot to cover. So,
Yeah, so on the funding situation, let me first give an overall comment, right? For me, there is a real funding winter for late stage companies who've raised hundreds of millions of dollars of capital, right? They are the ones who are finding it hardest to raise capital, right?
yeah.
If you look at the other end of the spectrum, which is the early stage, there is actually no funding winter. There's a little bit of funding spring because even the larger guys like Tiger and some of them who used to only write hundreds of million-dollar checks are now, by the way, far more open in participating in early rounds. So I don't see a real winter when it comes to early stage. That funding, if you look at most markets, India, you look at US, you look at Southeast Asia, in fact, over 21 or 22, 23 is slightly better, whereas late stage funding has completely collapsed. The numbers are nearly one third to one fourth of what they were at its peak in 21. So again, it's a differential funding winter across the life cycle, and you are in trouble if you've raised a lot of money and you're going to run out of money soon, right? So that is the kind of startups you should be losing sleep over. Now, what is different in diligence right now? I think across the board, I see investors asking far more difficult questions on unit economics and, more importantly, more difficult questions on the path to profitability, both at the unit level and also at the company level, right? So,
Mm,
again, particularly if you're Series A, I think there's a lot of scrutiny on what's the unit economics, how soon can you get there, and can you, within the next 1 year, give us some evidence that there is unit economics profitable. If you're Series B, Series C, where you've demonstrated some unit economics profitability, the hard question being asked is what's the path to company profitability, right? Because that at the end
mm,
of the day, investors are interested in net cash you're generating from the company and not that. By the way, this has also been shaped by the fact is that you had till 2021, and there was a huge boom period between 17 to 21. There used to be two or three big investors, shall not name them, who would always come
yeah,
at the end, triple the valuations, write fancy checks, and
yeah.
hopefully take you to your IPO. So those so-called investors of last resort are no longer there in the market. So every single person
Mm,
is a little bit careful. The second thing you should note is the people you are asking to give you money also raise money from other people, right? So LPs are also asking difficult questions, right? LPs have
mm,
told their GPs that, listen, we are not really interested in subsidizing burn models. We are not interested in getting startups to give money to customers. We are far more interested in money which gives us economics. So the level of scrutiny on unit economics is more. I think profit is no longer a bad word in the industry. It's actually a good word in the industry. So if you believe you have a profitable business plan, then you should emphasize that. And people are looking at how you are building the company, how you are building the economics, right? And the previous assumption that today I'm at X scale, if I'm 100X of today, I will magically be profitable is being taken by a bucket of salt by investors. I would tell you 2 years back, they would take it with a pinch of salt, but there was a lot of FOMO. The FOMO is disappeared. So any company which says, listen, I'm losing a ton of cash now, but if magically I'm 10 times larger, I become profitable, there's going to be a lot of skepticism on assertions like that by the investors. And we as advisors are often asked to really go deep and understand not only the unit economics, but also understand the future cash profile of these businesses. How much cash do they structurally need? And we found, right? I'll tell you one experience I know. All startups fundamentally underestimate the amount of capital they need, right?
mm,
Particularly technology startups or capital startups, they underestimate it by 3, 4 times, right? And then suddenly, if you've got and you scaled up and you realize you need 3 times more cash, you're again back on the treadmill to raise capital. So I think this is one of the learnings. I think investors also know this, and they are also asking us to look at the capex side, look at the capital requirement side of the future, to say that, listen, tell us frankly, this check we are writing, how far is it going to take the startup, and when are they next going to be on a funding treadmill? And if it's
mm.
under 12 to 18 months, that often raises red flags or what we call orange flags, right? I think
Sure.
people are far conscious of these. This was not that this discipline was not there in 2021. I think a lot of people are learning from the excesses of that.
Sure. No, thanks, Vanik. So let's the buckets that we talked about, and let's come back to the conversation. So let's try to like like deconstruct this in a very kind of understanding from a perspective of a due diligence. So starting from a business model, I guess what investors looking to validate is the business model is scalable, sound, like you said. What should be included by the founders when they are sharing this information? You shared some of the ideas as well. We should be sharing, but what goes in the due diligence process, especially when it is about the assessment of the sound business model. So can you give us like a very like a simple framework or simple kind of checklist that you generally follow? Of course, it's a long process, but typically what goes into this business model validation, so to say.
No, so business model validation. So listen, let's look at what we as advisors typically will do in a business model validation, right? As I said, market sizing is done independently and externally, so that if you have some information, share it. Business model validation, what typically advisors will do is they'll first understand what the product or solution space is, and I think the management team has to be quite convincing. There'll be a management meeting, right, where the advisor or the fund will go and ask you to present the solution of the model and ask 50,000 questions around it. I think management teams need to be well prepared for that conversation. And there are standard questions, right? Like as to what's the customer segment you're going after, right? What's the pain point you're trying to solve, right? How does your solution bridge the pain point, right? And remember, what people are not looking for, they're not looking for a train of logic. They're looking for facts and data, right? So if there's customer research you've done, there's customer interviews you've done, providing some of that collateral, both in either a quantitative research you may have done, or if you've done some qualitative focus group discussions, providing some of that material is helpful. If you're a startup who has a few existing customers already, whether it's an enterprise customer with two or three pilot accounts, or maybe a consumer client with 100 customers, I think investors are pretty interested to talk to a few of them, right?
Mhm.
Now, here, typically, the mistake I see startups do is they typically try to put their best customers in front of the diligence party. What we would do as advisors is we'll try to find the worst customers and probably go behind the startups back and see get some feedback. But strongly urge that you give a balanced feedback about what the product is doing to your advisors or to the fund so that they can come up with a view. Right. The third thing, which is very important, is and again, this is part of the business model as assumption, but it's very important at the early stages. What's the belief that the business scales up in the next 12 to 18 months? So if you're today
Mhm.
a B2B business, I think there'll be a little bit of scrutiny on order book, order pipeline, how much of it is real. Maybe there'll be some informal checks being done. If it's a customer B2C business, I think the question will be what's the next 12 months marketing plan, sales plan, channel partner plan, right? So some of these things will also get assessed. So again, fundamentally, you should remember what we are looking for. We are trying to understand that you have a product or a solution which is compelling to customers who are using it today, and we see enough traction for it to scale a few times over the next 12 to 18 months. If you're early stage, if you're late stage, then 25-30% growth. And we would often look at hard data, hard customer testimonials, right? Look at any analysis. The other thing, by the way, which is very important, and I'm still surprised that startups often get shocked when they are asked the question. We often ask, particularly if you have a consumer product, right? This is more relevant for consumer than maybe enterprise. People ask for a lot of data on existing cohorts of users by what I
Mhm.
call age of the cohort, right? So let's assume you're a
Mhm.
gaming company and you've been around for 18 months, right? I will ask for people who signed on month minus 18. What's that cohort, right? What's the data of those users, right? What's their daily average usage, monthly average usage, monthly churn rate, right? So for
Mhm.
consumer startups, I would really like to understand how people have behaved as they've spent time with you, right? And they're often very attractive numbers in terms of DAUs and MAUs collapse when you start looking at cohorts which seem to have aged a bit, right? So your
Mhm.
the customers you acquired in the last 2 months, all the numbers will look great. Maybe you've spent something on marketing, maybe you've done a great Discord program or a social media program. But I'm interested in the guys who joined 6 months back. What are they doing? What is their daily average users profile? How many people are still active on the platform, right? So that gives me a real window into what people are really doing with you when they move away from the marketing hype or the referral hype. Right? So this is a very important thing. We also replicate this for B2B, where we often go to customers, ask them, why did you consider the product? Has the product delivered what it's asked to be? will you repurchase the product, will you renew the license, right? And often some of the oldest customers give you the most harshest feedback. And
Yeah,
again, all of it is for me, for us to understand the distinctness of the product, and we are often sometimes share this back with the founders and say, listen, this is what we heard from your customers, can you give us some context as to why we heard it? In some cases there may have been a bug which got fixed subsequently, maybe there was something wrong, maybe the payment gateway was down for 2 days, so there are some valid reasons. What we're looking for is that even if there are mistakes, has the startup learned from those mistakes? So again,
sure,
it's quite intensive. It's not the data which is immediately there which is important, but age level cohort analysis is always done for any consumer startup. For an enterprise startup, people are going to go and talk to your customers and talk to everyone to see what their
sure.
experience with the product has been.
Sure. So I think one of the key learning I can take away from this conversation, Vanik, would be that be more fact driven and data driven, and be prepared for so to say Hindi mein gade murde as well. Because it's also going to be part and parcel of this process. So that's really good. I think rather than the half puff of the nice presentation, you should be ready with the real facts and figure. And if there is nothing, then it's best to tell that upfront, right? I think that's
Yeah,
what.
and give the bad news early. If there is some bad news, you please inform it early, right? Because if you say that, listen, we went through various versions of the product. This was version one. There were 5 bugs we found. Now this was version two. So then, when the diligence party, either the fund or the advisor, does their own independent investigation, they can then map the story. Oh, these customers were there
Sure,
when the payment gateway was not working, or these customers have come in when this bug was there. But if you don't
sure,
share the information, right, you're already asking, putting some question marks on the product or the business model, which you don't want to put, right? So again, you don't have to share everything, but again, share what is relevant, share what you want the other advisor to know. If there are mistakes which have been made, it's better to own them up upfront rather than having people
sure.
discover those mistakes and then ask you questions about it.
Yeah. No, I think great. I think building a startup is like a spiritual journey. You have to stay truthful, and like you said, your old karma will come from your college or whatever, right? So of course, the next topic is about the team. So of course, this is an important one. You said that already. How do you typically evaluate management team? Of course, take some feedbacks from the past and experience, track records. What else? I mean, and there's this very interesting question by Vidyasagar that in what if the previous employer gives a negative feedback because they did not had a friendly exit or they are the competitors and so and so forth. And so, and especially one of the very important factor, I've seen some deal fell through because there was no coherence between what co-founders were
Yeah.
saying. There were conflicts which were not very apparent, but in the due diligence process you found out. So how do you typically assess this element of team, and which is very subjective? It's like an interview thing, right? I mean, when we are hiring for people, it's a
Hmm.
very I know it's a very complex decision, and also very not always yes and no answer. But what's your typical framework? What's your typical process when you do this diligence around these topics?
Team assessments have been radically transformed over the last decade. I think if you look at 10 years back, people were more concerned about background, pedigree, colleges, employers, and brands, right? I think that was very superficial. I think people now have gone a little bit deeper, right? So I think at one level, what are let's step back and see what are we trying to solve, right? What is the real question the fund is asked, right? First of all, they are asking a question as to whether this person is a trustworthy person with an high integrity level and ethics, and that is like a deal breaker, right? So at one level, if there is any question marks raised on that, that immediately gets killed, right? So again, it's not about an employer giving you a negative review that people can know, right? If you leave a employer and go and work for the competitor, people will be pissed, right? But people are more concerned about the integrity, right? What did you do when you leave, right? Did you walk away with IP and stuff like that? So it's more. So for me, the integrity is to be completely. It's a yes no decision. If it's a no, then people will move on very quickly, right? So that's one thing they are asking for. And by the way, if you look at what's happened in the ecosystem in the last 12 months, I think
Yeah,
it's become an increasing concern with all the corporate governance failures and all of that. And people are beginning to ask hard questions on this, right? As okay, let's find out, right? Are we dealing with someone who's fundamentally trustworthy? The second thing, which is actually very simple for us to understand and also identify, is if you look at the industry or the problem statement which the startup is trying to solve, right? What are the unique skill sets, right? Each of the founders bring to the table to solve the problem, and those skill sets complementary and do the work together as a team. What this does not mean is that the guy who's the product inventor or product founder also needs to understand business or sales, right? But amongst the founder teams, is there what we would call a minimum evidence of minimum skills needed to run a business, or at that level, right? So do you have a combination of technology, right? Combination of someone who understands the industry, maybe someone who knows how to sell and manage customers, right? Someone who knows a little bit of marketing, right? So, does the founder team have at least the minimum kind of experience needed or expertise needed to take the company from zero to one? Obviously, you don't need to have 20 years of FMCG experience, right? People understand that some of those experiences will come along the way, right? But is there a minimum kind of experience and expertise mixed in the founders to pull this off, right? Now, that may not be true. A lot of people have got funded who straight out of college. I think there people are again betting on whether they see that spark, which is very hard to identify. Do they see them as a guy who can just build whatever he wants to build? And again, there are markers for that, right? People look for people who are successful serially, and people who have failed and have learned from it and have come back much stronger. So there are a lot of markers people look for to even when you don't have the experience or the CV to test for it, and that is increasingly becoming important. The third thing, which I think all of our firms and funds ask us, do we believe that the founders are open to input and open to learning? And this has become very important over the last 2 3 years because people believe that the era of the superstar founder is gone. Right, the environment is dynamic. There will be people who know more about something. The environment changes. So are these guys open to learn, open to pivot, open to take advice from their board members, open to take advice from or learn from what their competitors? So is there a fundamental mindset for them to learn, right? Which is different from someone who says, listen, I know what I'm doing and this is the only thing we do. By the way, most successful startups and people who've become unicorns, decacorns, publicly listed companies have made significant pivots along the way, right? As they've found their journey. If there is no mindset for learning and no intellectual humility to admit you're wrong and then move on, you will never be able to build a successful startup. So these are some of the questions which are asked. These are very hard to assess, by the way, right? So again,
Mhm.
I will not claim as an advisor I have a very formal framework or a quantitative approach to do it. It's sense, right? Yeah, do we like this guy, right? Do we like the team? What's the energy with the team? Do they work with each other? Do they always say yes to each other? It's not a good thing, right? Do they fight? But are those fights constructive? Uh, we often see that founders often have allocated responsibilities between themselves, but I often insist that everyone shows up for every meetings because we see if they're working as a team or as individual silos. So this is important. I think gone are the days where they are just assessing you with your CV. I think there is a little bit more detailed assessment. And by the way, forget about advisors. The investors will call your former colleagues, your friends. They will ask feedback about you. They will understand what your strengths are, what your weaknesses are, right? Are you open to change? Things like that are asked. And even for first round checks, people will do 2 3 phone calls about the founders, right?
Sure.
So again, this is increasingly becoming important. So here again, I would advise founders to be quite open and transparent about who they are, what they do. There's no harm in telling your investor that each founder brings their own sets of skills, brings their own strengths, and bring their own weaknesses. It is not bad to educate the fund about the complementarity in the skills and the strengths which different founders bring, and what role everyone plays, and how they work as a team. And that is what the firms need to know. Now, as you become more larger, then people do second level assessment. If you're writing a Series C, Series D check, I will want to look at the founders. I will look at the founders minus one. I will look at the founders minus two. I would look at things like churn in the team, right? Senior leadership churn is an orange flag for all startups, right? If you're a founder who's
Mhm.
accepted that you need help, which means you need professional managers, but you chew through your professional managers in a matter of months, that's not a good sign for investors. So again, some other nuanced metrics come in as you become larger. We often also look at things like employee churn, employee satisfaction, because those are also very good metrics of founder behaviors. It's important to understand, is your churn beyond norm? If people have left, why have they left? If some people
Mhm.
were rock stars, why did they leave, right? So these are all very important indicators, because in a startup, I think all behavior and culture is set by founders. And if people are
Sure.
leaving, then something the founders must be doing wrong. So there are lots of ways to look at it, but I will tell you, versus a decade back where this was 10% of the scorecard, right now it's probably number two or number one of what people will evaluate, and they will try various tricks and tactics to look at this.
Sure. No, thanks, Barnik. I think very, very interesting. And like you said, transparency is the key. And also, important is to, be upfront, be open about, and also be careful from early days. It's not that you will be doing this later when you are not, when you will get at a stage. I think it's like you have to build that entire history of everything. So that's a very, very valuable input for even the early stage, entrepreneurs who are building the organization, thinking that I'll just do it, just however, but it's gonna come back, it's gonna come back at some point. So it's like a karma, it's again like a spiritual conversation in that ways. So thank you for that. So on like quickly on the financial, although we have covered a lot on financial in the past with our lives, but when we look at financial health, some of the factors that you look at uh, in the due diligence phase, I mean, of course, I'm talking more because it's a vast topic. To narrow it down, can we talk about, let's say, startups which are deep tech, who have not so much of revenues at this stage, but there is a potential for that. What goes into that kind of due diligence, especially when there's nothing to, as such, to look
Assess the
at?
company.
So yeah, so what would be your way to do it?
Now, listen, see, typically as an investor, they would conduct two sets of different financial diligences, right? One would be a business plan or a commercial diligence, which is to see, is the business plan robust? Does it make sense? What are the assumptions? There is often a formal FDD or a financial diligence where people are going to look at accounts, are going to look at what is the last year's revenue, profit, what is the budget for this year, and all of that. And I've been quite pleasantly surprised to see that even for Series A checks, people are commissioning advisors to do financial diligences. So I would strongly advise that even if you are a early company, right, please keep your books in order. Please ensure all compliances are done. Please ensure, and by the way, you don't have to hire armies of people. There are enough CA firms who do this on an outsourced basis. They may charge 15,000 to 20,000 rupees a month, nominal fees, but proper bookkeeping, account keeping, cash registers, payables, receivables management is just a sign which investors want to see as to whether you will be disciplined when the money comes in. So again,
Mhm.
it's not about how large you are and you've just started. I think there's no excuse for poor bookkeeping or poor account keeping or not being in compliance. Increasingly, by the way, the authorities, particularly in India, have been very tough on people who are what they call serial offenders, right? People who
Yeah.
consistently late on accounts, late on submissions, late on filings, right? And they don't take a very positive view to this. So again, it's as everything else. You do not need to be large to have proper accounts. And I have been quite pleasantly surprised to see that even in Series A, funds are commissioning FDDs to understand the nature of the accounts, the nature of the books, who's getting paid what, right? What is the way you're managing payments, right? And by the way, the good news for a startup is this was not true 10 years back. You now have an ecosystem where people provide these services to you for a fee. You don't need to hire a big team for it. You just need to know who it is. You ask maybe your angels, maybe other batchmates or seniors as to who to use, and you'll get a list of names, right, which come through. So this is important. I think the other thing people also look at is contracts, and this may be a legal vetting, but also financial vetting. So again, I would tell you it's not just an advisor looking at a business plan, but FDDs are becoming very important. We were doing a recent diligence, right? Someone writing a $2-3 million check for Series A, and at the end of the commercial diligence, we got a set of questions from the investor saying the FDD has now thrown these questions out, right? Uh,
Mhm.
uh, we've noticed in the FDD that there was some customer churn, right? Have you guys found anything about satisfaction of customers, right? So some of the FDD results are going back into the commercial diligence or the business diligence to ask questions. So it's become very important. And in this environment, right, where a few people have earned very bad names for the full community,
Yeah.
right? It's better to be more careful as an investor, because remember, investors have nowhere to run to, right? If their capital sinks because of poor governance, I don't think their LPs will also keep on forgiving them forever, right? So I think
Yeah.
they are going to be far more cautious. And as a startup, I so see no reason why you wouldn't do proper bookkeeping from day one. It's not that hard. If you don't know how to do it, get someone else to do it. It costs very little money. It actually saves you a lot of money, right? Because the cost of non-compliance is orders of magnitude higher than the cost of compliance, right? So I don't think you should shy away from doing it. But remember, investors are going to look at everything carefully.
No, sure. No, thanks, Banik. I think I also had the similar experience about bookkeeping that you keep on a very, sasta sundar tikao CA and then eventually pay more in the funds and you just cover that whatever you saved. So I have seen this happening and I have seen this, happening with a lot of people as well. Now, you briefly touched about legal and regulatory compliances. What sort of documentation you typically look at? I mean, if you can just give a broad buckets in interest of time, what kind of compliances and regulatory that things that you look in the due diligence typically?
No, no, see, in legal, it's quite simple. Most of the industries we've looked at are not regulated industries. Legal compliances are simple. It's accounting compliance, tax compliance, right? It is compliance on contracts, right? Because you don't want to be in breach of contract. So there's fairly simple toolkit to do it. I think often people will also see, and it doesn't happen often, but are there any civil or criminal cases which need to be reported? Sometimes there are disputes with vendors and all of that. So some of that documentation is needed. Regulatory diligence is needed more if the startup operates in a regulated industry. I think there this is relevant for in India. I think it's relevant for fintech, particularly fintechs who are going to move into banking licenses and all of that. There are very stringent playbooks you have to adhere to. RBI has some norms and all of that. Typically, I have seen firms hire specialists to look at this, but for most of the spaces in India, we are not that well regulated, so it's not an
Mhm.
important thing. But I think legal diligence is fairly simple. I think people just look at contracts. They look at all kinds of contracts the company has signed, right? They'll look at employee contracts, they'll look at founder contracts, they'll look at supply contracts, they'll look at customer contracts, and they will look at all the regulatory filings that you need to do. And there are a lot of filings. There's GST filing, tax filing, there's corporate tax filing, there is Companies Act filings, there are a bunch of filings. And the way it happens is typically the investor will give you a checklist. They'll ask for a data room, it gets put into the data room, and then they have a small team going through all of it to see if there are big red flags. So for me, the legal and regulatory diligence is just seeing if there are any big red flags which would make them not invest in a deal. So it is not, it's something which doesn't qualify but can disqualify you if people find mistakes, right? So it's not a qualifying diligence, but it's important. And if you're in a regulated industry, particularly like banking, there the regulator has their own set of compliances and norms which people will often check. Now, you may on regulatory compliances get a little bit of a pass if you're an early stage company because you're not aware. I think your investor will come and insist that you hire someone to look at it or you hire a firm to look at it. So you may get a bit of a get out of jail free card early on. But if you're a bigger startup where you have raised a lot of capital, you have a lot of revenues and all of that, lack of regulatory compliances is a severe red flag, right? So while it may be a yellow or orange flag earlier in the process, but later stage it actually throws up severe concerns for investors. Because remember, if you're investing in regulated industries, you also are up for scrutiny as an investor, right? So again, it
Sure.
just the bar gets higher.
Sure. Now, next question is of course related to what I kind of do in intellectual property, and more specifically, I'll talk in and keep it context of deep tech only. You've been an investor in deep techs. You have been doing this due diligence as well. So when it comes to intellectual property due diligence, we had brief conversations also. What typically look in the IP due diligence beyond, of course, patents and trademarks and copyright? I mean, what do you look at when you talk about intellectual property as a big bucket of, and especially in the context of deep tech? And I want to combine one more questions around it is around the technology risk which comes with the intellectual property as well. That while there's intellectual property, there's also a technology risk which is happening, which is going to happen,
Yeah.
or which is possible to happen. So your take on this entire IP and technology risk, especially in the context of deep tech startups, that would be a really interesting
Yeah, so let
conversation.
me let me answer the question in reverse order. Let me talk of technology first, and I'll come to the role of IP.
Sure.
Right? For me, one of the fundamental pillars of a commercial assessment of a startup, particularly if they are in a technology space, is the technology itself. Right? There, I'll tell you the kinds of questions we're looking to answer. I think the first, all startups we run into will make very tall claims of their technology. They will say it's the best. Recently, we ran into a startup which didn't have a commercial grade technology, but they had lab technology, and they claimed some numbers and all of that. So we will look at it very carefully. And there are two questions we ask ourselves, right? First of all, is the technology fundamentally competitive, and do we see other people using it, right? And contrary to popular opinion, actually, it gives us more comfort if we see other players around the world are actually using technology which looks similar to this so-called breakthrough technology which has been given to us by the founders, right? Because it gives us comfort that there are other people who've taken risks on it. We've often used that to look at, particularly in early stage deep tech companies, is that if it gets commercialized, what are the kinds of throughputs and yields which come out of it? And that gives us a lot more comfort as we plug those assumptions back into the business model or the financial plan, right? Everyone will claim that in the laboratory, the technology has 99% yield and throughput, right? But then when we do a little bit of deeper assessment and we find a company which is slightly along the journey, maybe they've raised their first check 3 years back and they've actually commercialized the technology, and their yields and throughputs are maybe 78% or 79%. So at least we know, right, that it is, listen, worst case, the downside to the business case is 15 percentage points of yield or throughput and not 50 percentage points, right? So for me, I think the first question we try to ask is, what's the competitiveness of the technology? Have we seen other people use the technology? And where is the industry headed, right? Is this a technology which is becoming more mainstream, or is this a technology which is getting phased out, right? And by the way, you get a lot of interesting insights, right? A lot of people will take old technologies, refashion it, and do it. But again, we are fundamentally trying to understand, is this technology going to make you a competitive player in the industry for the next 5 to 10 years? We also try to take a 5 to 10 year view, right? So, in which, by the way, one of the very important things we assess is the role of alternate, substitute, or complementary technologies. And again, it's very hard to explain this generically, but let's just talk of electric vehicles as an example, very simple example, right? One of the classic questions we are asked, if you're a two-wheeler EV, either battery manufacturer or a scooter or a three-wheeler companies, will hydrogen replace batteries in the next 10 years? It's a very simple question. It's on all investors' mind, and we do reasonably detailed assessment of hydrogen, and we will then often come back with a nuanced answer to say, listen, at least for the next 10 years, there's no real threat. There may be evolution in battery technology itself. Maybe lithium batteries may evolve to solid state batteries. We are still 5, 6 years away from that. So we see a decent runway for the current company to monetize the technology they have without threat for mass scale substitution. So that is one level of questioning which we as advisors take very seriously, because we don't want to back a technology and in 2 years something displaces it and all of us have eggs in our face, right? So it's something we lose sleep over. We ask ourselves, and as I said, EV, we are always asking ourselves, what will happen if hydrogen comes in? Right now, a lot of investors are asking the role of biofuels, right? There's ethanol blending happen. So substitute technologies, complementary technologies is part of the assessment. And here, by the way, unfortunately, the startup can't do much. I think the fund and their advisors have to discover their own answers, because anything they hear from the startup, they will take with a bucket of salt, right? No startup is going to come and say, listen, my technology is going to get substituted in 10 years. So there's a lot of assessment. I think you should trust the fund's judgment. Sometimes the funds look at the risk profile and say, listen, no, in heavy commercial vehicles, hydrogen is imminent. I think this is going to come 6 years from now. I don't want to take a risk funding a startup who's doing a heavy commercial battery operated vehicle. Please, not my risk appetite. I know monetization will happen 8 years from now, and I don't want to be in an era where these technologies overlap. So I think there is very deep technologies. Let's come to IP. Again, there are two ways to look at it, right? Are patents enough? If someone claims that I have patents and I'm IP, we always, as advisors, look at it with a bucket of salt. Unless we fundamentally assess the technology and are convinced on the technology, we will not look at the IP and see if the IP actually is protected. But increasingly, for Series B, Series C companies, if you don't have patents and if you don't have your IP protected in some shape or form, right, that often raises orange flags again. Because if you're really a deep tech company which has proprietary technology, you've now been at it. A Series B, Series C company typically is at least 3, 4 years into its journey. Why haven't you patented it yet? Or what's wrong? So for me, in a later stage company, absence of formal IP raises orange flags and red flags. Whereas in an early stage company, I'm far more convinced about the fundamental differentiation the competitiveness of the technology that versus whether you've got the patent or not, right? And you should
Hmm.
also talk about it. You are the expert in the field. I increasingly believe that it's a very complicated area. For example, there is a startup whose advisory board I was on, where they had proprietary IP, but then they were commercializing that IP with partners, and there was a lot of debate on who would own the ultimate IP, right? And then I remember our IP lawyers came and said, let's agree on foreground IP, background IP. Startup owns background IP, foreground IP is jointly owned. So what we are looking for is this: has the startup applied enough intelligence into this process, right? Because tomorrow, what you don't want to happen is that your customers with whom you've tested the technology run away with the technology, right? Have you given enough thought to this? And by the time you get to Series B, Series C, it's no longer about potential or promise. It is about performance. Have you delivered on
Yeah.
it? Is it patented?
Yeah.
You have the copyrights which are necessary for you to succeed. You may get a pass in the early stages, but if you're later and you're asking me for a $150 million check, I want to see your patent portfolio. I want to see it. I want to see where do you have it. What's the nature of it? By the way, I've seen a lot of funds will do an IP diligence. That is
Yeah.
a pure IP diligence where they look inside the IP. Maybe your firm, Govind, also does some of it for funds, right? But you will do something very formal to ensure that it's all in order. Yeah.
Yeah. No, that's true, and I think if I may add some bit of it, that's what I have seen is IP. Of course, you beautifully put around that patents are not everything, and I for the change I tell that for a lot of our startup clients that hey, look, of course, business model is important. The path to profitability is important, and IP is, yes, like you said, it's like a good checklist for the for the investors, and also like a validation. It's like a supporting actor in a story, right? It's not the main character. Business is the main character, and you have to support it however you want. And it's a combination of patents, trademarks, and a lot of different things. It's not only, of course, patents are important if you're a deep tech company, but also other aspects of the IP is very, very important, right? So I think I resonate what you said, and I think makes a lot of sense logically as well as practically
No,
as
I think
well.
one thing I'd caution startups to do is not claim that technology is your moat.
Hmm.
If you claim technology is your moat, you're inviting a lot of deep scrutiny into
Yeah,
your startup, right? So
yeah,
technology over a period of time can become a moat, right?
yeah,
Often it's business model or the first to scale up, or maybe a brand positioning, or maybe you've got the early customers, maybe it's marketing excellence. There are lots of moats, right? But again, remember, claiming technology to be a moat, you have to prove it, right? And that's where Govind, you will be summoned by the fund to prove that the technology is a real moat or not, right? So again, I
absolutely,
would be careful
absolutely.
before making really tall claims on technology, right? Because
Yeah,
again, I hear a startup founder who's not commercialized his technology comes and tells me this is the best technology in the world. I have
yeah,
99% yield. And then I tell him that, listen, I have found 10 other companies who are doing this at much larger scale and their commercial yield is 75%. Now tell me, why should I assume 99% in the model or 75% in the model, right? So again, be a little humble about it. I don't think just doing an engineering degree and 3 4 year work experience, you've invented a technology which people have not thought of before. So again, be a little careful, be humble. I think often moats are built by business model, great execution, great teams, and all of that. There's a lot of differentiation in that. But again, if you're claiming technology to be a moat, your technology better be good and patented and copyrighted.
absolutely. I think again these are, like you said, earlier, that markers are important, right? And I always say that hey, IP is a marker for technology, right? I mean, of course, there is no black and white in any world, be it T, be it, and same for IP as well, right? That it's always a marker that how well your IP is written, how well you have done it, how what's the strategy, and then it gives a marker to an investor, right? It's never like a black and white anyways. I mean, for any due diligence, for whatever we do, right? And I'm sure we always put these and look these markers and kind of present our findings, right? We are almost on kind of finish the time, so I'll extend only by 5 minutes because we have one very interesting question from Abhishek. I'll probably skip some of the question I had planned, but Abhishek has a very interesting question. What would you advise startups at the seed stage to keep their compliances in order to be ready for pre-series or series, any priority checklist? So would you share some of the like your favorite checklist for Abhishek today?
Okay, so again, I would keep the checklist across the elements we just mentioned, right? I think one you have to be, let's look at the elements of the diligence which will happen in your seed state. So there has to be good documentation of the market size and the market TAM. I have found intelligent startups who spend a lot of time Googling research reports to often justify it. So have it ready if you have some of it ready. If not, see if you can call some people and see, talk to TIE, talk to NASCOM to see if they have some numbers. So have some kind of market sizing ready. Secondly, I would strongly urge you, if you already have a product or a product concept or a technology, have some amount of customer validation of it, right? Whether it's a real customer pilot or some people have tried it, have some feedback, have some data, which is most important. So there's some customer data and customer feedback. And if there is any consumer research, and by the way, here primary consumer research is worth its weight in gold, right? If you can do some both quantitative and qualitative consumer research, have it ready, have access to it, open that up. So I think from the product market fit, just understanding what your consumers want and having some documentation on that is important. The third thing for me is to have a robust business plan, and the business plan has to be solid. I think you should get it checked if need be by some friends, ensure that it scales up properly, ensure it doesn't do any magic, which means suddenly you don't become profitable with doing nothing differently. So again, you should really understand what drives the economics, and remember, the 5 year, 7 year number is less important or as important as the 1 or 2 year number, right? So there's a lot of scrutiny as to what happens over the next 12 to 18 months, which will do. So having some details around that helps. Fourth, just ensure you're in compliance in terms of all your financial and regulatory filings. Tax filings need to be done on time, GST filings need to be done on time, accounts need to be prim and proper. So just have it ready. And what you could often do is uh, have this all documented and kept centrally somewhere, right? You will learn this term called data room once you get into a diligence, right? So they will say that, listen, uh, uh, is your data room ready? Is your data room open? So you should have a mindset that let's have the data room, and actually whether Google and see what's in a data room, right? So you go to the data room, Google data room, you'll always see a checklist of things you already need, right? So always have a ready place, central repository where some of these documents are there, is easily available to the founders, right? Have all contracts, legal contracts, employee contracts, founder contracts, vendor, supplier, customer contracts, all in one place, because the first element of diligence will be they will be asking for contracts, right? So have this in one place, right? So I think the best place to see is if you Google and find out on Google Data Room, they'll tell you all that you need to have. If you can keep your data room 70-80% populated before you go to fundraising, you will be ready. I think there'll always be 20% new questions which will come, which will be there. You will find the process very traumatic if you have to unearth or find 80% of the data people are asking you to find. You will find the process less traumatic if 80% is already collated and you have to spend time only on 20%. So that's what I would have. It's not very hard. There's a lot of founder tools you'll find on that. But again, it's the basic stuff which has to be there. But remember, right? Perspectives are fine, but in data we trust, right? So you need to have data for whatever you can build, right? Whether it's to consumer research or not of that, and people spend some time on it. People spend money on it. If you want to spend money on doing some consumer research, if you guys have done some A/B testing, then results of that should be there. People will want to go inside that to see what was the control group behavior and all of that. So have all of this ready, and it shouldn't be that at the time of diligence you're asking, oh, where is that file? I forgot about it. And then, no, that person left the company 6 months back. It went with his laptop, right? So some of these things are there. So again, have a proper file sharing system in your company so that everything gets backed up and in one place so that it doesn't disappear with people disappearing.
Yeah. Banik, I know we are out of time, but can we extend by 5 minutes? We have two more questions and then we'll
Yes.
close the conversation. Thank you for staying longer. So one of the question by Dr. Rakesh is, what about compliance of the security and of data and technology? Is that done typically in a due diligence process?
Uh, so cyber security assessments are done for larger companies, and also it depends on the space you're operating. And let me give you an example, right? If you're operating in a space where you're handling, say, US patient data, and a lot of Indian startups are offering services to US healthcare providers, I think there will be a lot of scrutiny on how you're managing the data and how you're securing the data. So again, there are some areas where there's far more data intensity and security, and there will be a lot of questions. In general, if you're not handling sensitive confidential data, which is usually sensitive personal data, And again, remember, you have to. I tell all startups that it's better to be GDPR compliant upfront than discovering that
Mhm.
compliance later, right? So I think you should try to be GDPR compliant from day one, right? Because it's very hard to, because see, GDPR is the most, I would say, the stringent norms for privacy and data security. So it's easy to be compliant, and those norms are very transparent. What typically happens is as you become larger, I think there's a lot of scrutiny on data security, cybersecurity solutions, right? I strongly believe, and this I'm not doing a software pitch for any of my clients, but we should try to use standard industry grade solutions, because standard industry grade IT solutions come with built-in cybersecurity protections, right? So again, I'm not going to tell you whether you should use AWS or Google Cloud or Azure, but if you're using any of these, they typically will come with the necessary cybersecurity protections for your data to be protected. So again, a checklist here, or a hack, right? Use industry grade solutions, which are proven, which investors like, and which for which if you need to pay a little bit more for license, it's there. But again, I believe that cybersecurity will increasingly become important, particularly if you're dealing with large amounts of data, and if it's personal data, then you are subjecting your investors to a lot of liability in case that gets leaked. So it's an area which
Mhm.
is not asked enough of, but I believe there is enough scrutiny which happens in later stage companies, which should happen earlier.
Yeah. No, thanks, Banik. And the last question, it's also want to add, we have done this, live with, one of the, data protection officer and one of the law firms last live, which was around the DPDP Act, which is now in India as well, the Data Protection Privacy Act. So I think it may also help to kind of look at that as well. The last question we have by Hirsch: if the investor invests in seed round but decides to exit at the next round, will it be taken as a lack of confidence in the startup? What's your typical take as a DD process?
Uh, yes and no, right? See, remember, each investor has their own exit strategy. And see, typically, what will make me nervous is that if some investor typically stays for 5, 6 rounds, has decided to exit in the next round, that will be a cause of concern, right? So for me, it is not per se the fact that someone wants to exit. Maybe that person wants to exit. It's pretty common for angels and early stage funds to want an early exit because they are cash strapped and they want to recycle their capital quickly, right? But I would be a little bit concerned as a diligence advisor if you see some of these marquee names who not only stay on but often write three subsequent follow-on checks. If they exit, that's going to raise an orange flag, and I'd want to know more of this, right? So again, for me, it's not a lack of confidence in the startup. Maybe someone has lost conviction in the space, right? I'll tell you, for example, again, I don't have a lot of personal conviction in the space, but after the spectacular collapse of crypto, there were funds who had built huge portfolios of investments into crypto and NFTs, just stopped investing in the next round, right? Again, it was not a lack of confidence in the startup, it was a lack of confidence in the space, right?
Mm.
In fact, some of them who did decide to follow and actually encourage their startups to pivot their businesses to more utility kind of plays, and they wrote for subsequent checks, right? So for example, Polygon was encouraged to become a provider of Web 3.0 solutions to players, right? And they said that, listen, we are happy to write a follow-on check if this pivot happens. So again, it's often not a good sign if a big marquee investor exits in the next round. That may fundamentally signal lack of confidence in the space or the startup. But for smaller investors, small funds who are always looking to recycle their capital, I would not read a lot into exiting within 1 or 2 rounds of investing. By
Yeah.
the way, I will tell
Thanks.
you one thing does raise a red flag, and I'm a little bit old fashioned, right? A founder doing a secondary early on raises some flags, right?
Mm.
I'm a little old fashioned on this. That does raise some questions, right? And by the way, we have now enough case examples of people or founders who've had good secondary exits who've lost interest in their business. So again, it's okay. You often need to ask for secondary, but a very important question which is asked is how invested are the founders
The
in the startup
founders.
of the company, and the parameter we fill is what is the pre-dilution ownership of the founders and what's the post-dilution ownership, right? And no one likes
Mm.
to invest in companies where the founders own 15, 18% of the company because they've given away.
Sure.
So again, this was not true in 21, 22, but with guys like Sanjeev and all that speaking about this, I think founder secondaries are probably becoming unfashionable again, which I think is the right direction of the industry.
Great. Thanks, Varnik, and thank you for staying back. In essence, what I understand, the strong need of problem space, the economic strength, like an underlying business model being built, and the conviction of the team that will build the solution is the foundation of everything. And I like the framework. Thank you, Barney, for sharing that about you know the potential, the promise, and the performance. Amazing framework for any due diligence process. Thank you for being here today. Anything that you would like to, as a last bit of wisdom for our audience, and then we'll close and
No,
we'll have a good evening.
I'll just
Yeah,
say that don't be afraid of diligences. I think they are great learning experiences. There's also a saying that what doesn't kill you makes you stronger. So even if the
yeah,
diligence doesn't succeed, you don't get the capital. I hope you learn something from it and get better and be better prepared for the next diligence. So I think it's you go to the dentist to get something fixed, right? So it may feel like a root canal, but sometimes it points to problems which you may have or which you not be aware of. And I would for me, again, a diligence is a testament that someone is interested in you. So take it seriously, be honest, take it openly. There may be some good feedback which comes back for the startup from the diligence. Also take that positively, because those are good signs for your business in the long term.
sure. Thank you, Barney. Thank you for staying a bit extra for us, and great insights. A lot of comments, a lot of live audience staying till the end. Thank you, audience who have been here. Thank you, Barney. Have a good evening. I know you are in a different time zone. Have a good
Yes.
night, and see you very soon.
Take care. Bye.
Thank you. Thank you, audience, for all your support. Thank you for staying back. And do not forget to follow me and our company page to get the future episodes. And follow Arctic Invent for newsletter IP Berry for all the things around startups and IP. We also have this WhatsApp group for startup founders. Please do ping us to join it. And thank you once again, and see you in the next episode.